This Spotlight on Investments is sponsored by Financial Independence Group. Our products are strong, but our strength is in our people. For more information, please visit joinfig.com. Finra paid its top 10 executives a total of $11.6 million last year as criticism surrounded member firms about the regulator's executive pay practices. CEO Richard Ketchum received salary, incentive pay, and retirement benefits worth $2.24 million last year, according to Finra's annual report. The vice chairman received a total of $1.26 million, and Finra's CFO earned $1.18 million. Finra's pay practices drew criticism from members after the regulator lost $568 million on its investment portfolio during the recent financial crisis. Executives' total pay was 52% less than the $24 million received by the 10 highest paid managers in 2008, a total that included more than $7 million in retirement payouts to employees who left the company that year. During Finra's annual meeting, brokerage firms approved a proposal that would have provided members with the authority to reject pay packages through a non-binding vote. However, Finra's board declined to adopt the measure. Long-term mutual funds took in approximately $5.75 billion during the week before September 22nd, according to the Investment Company Institute. Equity funds experienced $1.9 billion in redemptions, with $2.5 billion withdrawn from domestic stock funds and $616 million transferred into foreign stock funds. Hybrid funds saw $741 million in inflows. Bonds took in $6.9 million for the week, with $6.2 million going toward taxable bond funds and $619 million to municipal bonds. During the previous 5-week period, equity funds saw $20.2 billion in redemptions, and bond funds received $32.9 billion in inflows. Hybrid funds experienced $716 million during the same period. The financial bailout will cost the government less than $50 billion, announced the Obama administration on Thursday after AIG finalized a plan to repay the government for bailout money received in 2008. TARP was initially expected to cost the government $101 billion out of the $390 billion invested. The Treasury Department expected a loss of $45 billion on the bailout of AIG alone. The agreement reached between AIG and the government requires the U.S. Treasury to trade its approximately $49 billion of preferred shares in AIG into about 1.7 billion shares of common stock. The Treasury will then sell those shares over time. The administration said the plan could result in a profit of approximately $20 billion if the government could sell the shares at Thursday's market prices. On Thursday afternoon, AIG shares were up 4.4% at $39.10. Treasury Department officials are discussing strategies, and selling of the shares is not expected to begin until 2011. For more industry spotlights, visit producersweb.com.